For the last 70 years, Warren Buffett has shared his wisdom and investment approach to the public. But have you ever wondered why so few investors that followed his advice succeeded? Welcome to 5-Star Finance. To begin with, Warren Buffett is a person who likes simple things. He likes to focus on the fundamentals, and that is what investing requires. If you want to invest like Warren Buffett, you must learn his 4 rules for investing. Rule number 1. A stock must be stable and understandable. If you are a bank lending money, you will probably choose financially stable people. You will want to look at his or her investing history, asset history, debt history, and earning history. If the person you are lending money to has a troublesome history, it might be a risky deal. A lot of people are attracted to a stock, even though there is not a lot of risk that is coming with it. The reason Warren Buffett is not attracted to such stocks is that he knows that a stable and understandable stock is something that he can calculate. For example, when a company is generating the same amount of profits year in and year out, they consistently grow their equity at 10% per year. He can predict what that company is going to be worth the next year and the year after that. Which brings us to the first rule. Never invest in a company that is unstable and you do not understand. Rule number 2. A stock must have long-term prospects. Holding a stock for the long term reduces the taxes you have to pay. In a nutshell, Buffett does not want you to invest in a company that sells TVs and antennas. If you're a young investor struggling with your study loans, Buffett wants you to go out and analyze companies before allocating your cash. He wants you to address certain questions before you invest. Questions like, will that company be around for the next 30 or 40 years? Does the world need the product they're formulating? Buy a company and hold on to it, so that the growth of that stock is reflected at the market pace and you'll never have to pay any taxes. Goods like chocolates were around 30 years ago, and it's easy to believe that people will still be eating them for another 30 years. On the other hand, we would not be confident about the emerging tech companies. Buffett wants you to think for the next 30 to 40 years. To put the long story short, don't invest in a company that is not expitant. Instead, look for the profits in the long term. Rule number 3. A stock must be managed by vigilant leaders. A vigilant leader is someone who's equipped with good foreseeing ability, someone that can genuinely predict where the company is headed to and what the necessary decisions should be in order to bring the company out of turmoil. This rule might be tricky for young investors looking to step into the market. What Buffett means by this rule is that the company should be managed by individuals who are good at managing debt. You want to stay away from companies that have any debts, which will also protect you from dividend traps in the future. The biggest threat a company goes through is not being able to pay back its debt, which eventually leads to bankruptcy. Investing in the stock market can be like playing with fire. Companies usually borrow money to invest, and nobody knows whether the investment will be fruitful or not. What makes the debt worse is the interest that comes with it. What Mr. Buffett wants young investors to understand is that not every company that looks profitable will generate profits. Invest in the companies with vigilant leaders. The leader or the owner should make sure the company is not running on more debt than it can easily afford. One important ratio that can show a company's debt level and is easy to calculate is the debt-to-equity ratio. Let's say you have a $100,000 house, and to purchase it, you paid $60,000 in cash, which is the equity, and borrowed $40,000 from the bank, which is your debt. Your assets are worth $100K in total. The debt is $40K and equity is $60K as stated earlier. In this case, your debt-to-equity ratio will be the $40K in debt to your $60K in cash, which will be 0.67. These ratios are useful for someone just starting up with investing and is trying to understand the dynamics. They also come in handy to analyze the debt a company is under, which can help you target your stock. Rule number 4. A stock must be undervalued. The ability to predict the uprising or downfall of a company depends largely on the philosophy of value investing. Warren Buffett always looked for companies that would prove beneficial in the long run. Short-term hikes in the return rate might feel easy on the eye, but they can result in adverse consequences after a few years. Before putting your money in, calculating and ensuring the margins of revenue is important. Never buy a stock that is overvalued. You must look for stocks that are not overvalued. Warren Buffett wants you to step in, analyze the company, and estimate what the intrinsic value of a stock is. So if you determine that a stock is worth $50, you always want to buy the stock for a price below its value. Let's say $40 is what you are comfortable to pay for that stock. You do not want to overpay. The name of the game really comes down to calculating the intrinsic value of the stock you are targeting. All these rules must be met with before you're stepping into the market to target a stock. Now that you've learned the basics of finding an undervalued stock, first you must know that there are a total of 6 stock categories and the ratio of each of them differs. We made a free ebook which you can find in this video's description if you want to learn more about it. Patience. Warren Buffett's investing principles are read extensively throughout the world, but one of his core teaching is to invest in yourself. Working on yourself can help you a long way in your journey to financial independence. Good financial practices, such as not overspending beyond your means, avoiding credit card debt, saving, and reinvesting your profits can pay huge dividends in the future when an investor can be patient enough to acquire these important practices. Alongside these financial principles, patience and discipline are key for your success in the stock market. When investing, you have 1,000 major corporations offered to you at a price, and a price that might be likely to change every day. The pitcher will keep throwing balls towards you. In real baseball, you either swing your bat or you strike out. In investment, you will see more than 100 steel balls thrown towards you, but you don't have to swing at anything. They may look like perfect pitches to swing at, but if you don't know enough about them, you don't have to swing at anything. You can sit there and watch thousands of pitches being thrown towards you, and finally, you get one right up there. Then, you need to swing. Patience is an important tool for investing. If you wondered from the beginning of this video why only a few succeeded following Buffett's approaches, check the explanation in a conversation Warren had with Jeff Bezos. Jeff Bezos: I asked Warren Buffett, your investment thesis is so simple. You're the second richest guy in the world, and it's so simple. Why doesn't everyone just copy you? Warren Buffett: because nobody wants to get rich slow. Individuality. Individuality might seem difficult for someone who's just starting to step into the market, while in the bigger picture, individual or retail investors have more chance to hit the jackpot. When investing, retail investors usually invest in small sums, and the stocks they are mostly targeting are included in their personal portfolio, unlike the organizational investing, in which the stocks are owned and included in the company's portfolio. According to Buffett, the problem with diversification or institutional investment is that the decision-making includes different individuals in the organization. The board of directors makes the decision-making process a very complex one, as people are likely to propose different ideas on different issues surrounding the company. For an individual investor, it is a one-man show. Everything revolves around you. You are answerable to no one. You are the person responsible for your mistakes as well as your victories, which can make life peaceful. Diversification might sound attractive for investors who are struggling to analyze what they're going for. It literally means that you're trying to protect your investments and you're trying to make sure that nothing bad happens relative to the market you're investing in. This renders you an inexperienced investor in front of the companies, and you're likely to fall into the dividends traps. Keeping it simple and trusting the index funds when it comes to investing your money might be more fruitful when it comes to the long run. Hit once, hit big.